This particular session is going to cover the structure of the foreign exchange market, in particular something called the spot market, and we're going to discuss some of the participants in this spot market, their roles, their motivations, and the relative size of each participant. So here's one number, 5.6 trillion. On a daily basis, that's how much currency gets traded around the world. If we write it out, that's how much in dollar terms. Per year, that amounts to 2.044 e to the 15th power, which I think is something like this number here, and I don't even know how to pronounce that. I do know that the annual GDP for the United States in 2016 was about $18.57 trillion. The amount of the stuff that the United States produced in a year, everything that is produced in the country, only makes up about that much amount. So the size of the financial market for foreign exchange is very, very large. As I said, much of it occurs in the spot market, but there are other markets as well that we'll get into in a different session. So let's talk a bit more about this spot market. Most of the trading here occurs in something called the Interbank Market. This is a little bit different than what you would see in a normal equity market or any other market where there's a common exchange. Exchange is in something like the NYSE or the NASDAQ. So an interbank market is, as it sounds, a market that connects different large banks for the most part. So in North America, you might have, for instance, JP Morgan, Citi. In the UK, although they have roots in Hong Kong, you might have HSBC. In the East, you might have something like, say, the Commercial and Industrial Bank of China. So the way this market really works is that if JP Morgan wants to sell or exchange 50 million US dollars into British pounds or GBP, they're basically going to call up CIBC, Citi, and HSBC and ask them, okay, what are you offering if I give you 50 million USD? How many British pounds are you going to give me? CIBC might offer, say, $1.56 for every pound traded, whereas HSBC might offer $1.58 per pound. If JP Morgan trades with CIBC, they know they get about 32 million pounds, whereas if they bought from HSBC, they'd be getting about 31.6 million pounds. Note here that you can kind of check your math and see whether it makes sense. If you notice that 1 pound buys more dollars, so if I take dollars, I know I'm doing right by dividing, in this case, by pounds, because when I translate dollars into pounds, I'm getting fewer pounds. So since each pound should buy more dollars, if I go back the other way, the pound is buying more dollars according to my calculation. So it kind of checks out intuitively. Sometimes it's helpful to do something like that. But the point is that the interbank market is mostly a market between banks, and there's no centralized exchange where banks go to buy and sell, make offers to buy and sell different currencies. For the longest time, it was actually all done over the phone between these different banks. And you would have customers that would need currency. I mean, you have retail customers, those who are going on vacation and need to travel, need to exchange currency for the place which they travel to, for example. But that's something where this person typically goes to their bank and gets money from the bank. But the bank is trading currency with other banks, and probably what it's going to do is just charge that person a higher spread between what they actually paid for the currency and what they're selling you the currency for when you go to travel. So that's a retail market. It's a little bit different than this interbank or the spot market. And that's not too dissimilar from what goes on when corporations need foreign exchange. When corporations need foreign exchange because they're buying and selling goods from other countries, and other countries, companies in other countries don't always accept that corporation's domestic currency, what will mostly happen is that that corporation will go directly to their bank and ask to facilitate the currency exchange. GM, in other words, won't go directly to the interbank market. And though they're probably going to get a better foreign exchange rate than that of the vacationer, they're still essentially transacting just with JP Morgan in this case, and not directly participating in the interbank market. Now this is changing somewhat as exchanges start to pop up and more foreign currency gets traded on these platforms, and a lot more of this foreign currency is traded algorithmically rather than over by the phone between different banks. But that's still a process that is ongoing, and much of the market still takes place in this interbank market. But interbank market or not, let's talk about some of the different foreign exchange participants. We mentioned one, actually two, if you don't include the vacationer. One was banks, the other was firms or entities that need to do physical good transaction or investment transactions in other countries and need foreign exchange to do that. And the banks are mostly facilitating transactions for firms, retail investors, but they're also doing some speculation on their own behalf. So they're market making, they're buying and selling on behalf of these types of institutions, these firms, but they're also oftentimes betting on which way they think certain currencies are going to go. You also have dealers, which serve a little bit of a function that's similar to banks and a little bit symbiotic with banks. Oftentimes a dealer is actually part of a bank, but sometimes, especially these days with the electronic exchanges, dealers are specialists that buy and sell and hold currency with the expectation of selling it to someone for a higher price shortly down the line. You also have speculators and arbitrageurs. Speculators can be as small as a mom-and-pop individual investor betting on what currency is going to go up or down. But there are also some very large hedge funds out there that specialize just in trading foreign exchange. There are proprietary shops as well, which means that they don't take outside money, but that's a little bit beside the point here. So a speculator might see that today the yen is trading at 120 yen per dollar. And perhaps they think that interest rates in Japan are going to rise, and for a number of other factors, the yen is going to increase over the next 2 weeks. So if they're trading at this time, they wouldn't want to be having positions in dollars, they'd want to be transferring their positions into yen. They'd bet on the price of the yen rising temporarily over the next 2 weeks against the US dollar. And suppose it did. Suppose it went from 120 yen to 110 yen, and then they close out their position for a profit. Notice that the graph went down though, and I'm saying that they made a profit. Can you see why that is? Well, one way to look at it is walk yourself through it logically. 2 weeks later, the same dollar is now able to only buy fewer yen, only 110 yen, whereas 2 weeks prior it was able to buy as much as 120. So logically it makes sense that relative to the dollar, the yen has become dearer. But another way is to walk yourself through an example. Suppose that you were a US visitor to Tokyo, and Hilton Tokyo, because it's in Japan, sells rooms at a rate of yen denominated at a rate of 150,000 yen per night. Actually, that's a little bit expensive. Let's call it 15,000 yen per night. So 2 weeks ago, you as a US tourist, that would have cost you about, at a rate of 120 yen to dollars, in dollar terms, that'd be $120. But 2 weeks later, today, the exchange rate is 110 yen to the dollar. Now, hotel prices fluctuate quite a bit on the basis of demand and seasonality related to that, but they don't fluctuate that much according to currency. So the hotel rate is still probably 15,000 yen per night. But with the exchange rate now at 110 yen to the dollar, to the US visitor, this feels like, to him or her, $136 a night. Quite a bit of a rise. And by the way, sorry, this should be 125, just a math error. You still see the same point though. But the takeaway here is that yen-denominated goods have become more expensive to a US investor. And this is the idea behind the stuff that you sometimes see in the financial media about a country weakening its currency to boost exports. But that's an idea behind speculators and how they make their money. Now, arbitrageurs make their money on the basis of temporary differences in prices between different quotes that they get. So what an arbitrageur will do, will at a very high frequency ask for different quotes, and this can be the interbank market, or it can be the electronic exchange, or various electronic exchanges. They'll ask for different quotes from different entities. So perhaps for a very short period of time, HSBC and JP Morgan are not taking quotes from each other, but Alpha Capital, the arbitrageur here, is. And they look at the US dollar versus British pound rates for these two firms, and they see that JP Morgan is offering to buy US dollars versus British pounds at a stronger rate than HSBC is willing to sell. What they'll do very quickly is purchase from HSBC and then go over and sell to JP Morgan pretty much instantaneously and earn basically a penny profit on each currency that they sell. Small amount of profit, but relatively risk-free. Okay, two more participants. First, brokers, which are not too dissimilar from dealers and banks. The difference is that dealers and banks are sort of like the used car dealers of the foreign exchange world, whereas the broker is more like a real estate agent. And what I mean by that is that dealers and banks hold inventory. That is, a used car dealer, for example, will purchase a car from you and attempt to find someone willing to pay a higher price for it. But they have purchased from you, taken title, and are now holding it as inventory. That's not the case with a broker. Just like a real estate broker never actually takes title to the house that you intend to buy and then sells it directly to you, they simply broker the transaction. And brokers serve a useful purpose, and they often work in conjunction with dealers and banks. A broker lives by its connections, and so if, say, a bank, in this case, let's say it's JP Morgan, needs to offload $1 billion of US dollars, and they need to change it for yen, JP Morgan doesn't just want to start calling all the banks out there and try to exchange as much yen as possible, because the other banks are going to smell something is up. They're going to smell that JP Morgan needs to offload a ton of dollars, and so the banks are going to take advantage of that by raising the, well, in effect, paying fewer yen than they need to, because they know that JP Morgan is kind of desperate. So what JP Morgan might do is go to a number of different brokers, actually, and ask brokers to trade this piecemeal on their behalf. But when they trade, the brokers are not supposed to reveal the identity of the client they're trading on behalf of. So they'll go and try and sell a little bit to Bank 1, a little bit to the other dealer that they know, a little bit quietly to Bank 2, and when they do this, they never actually reveal that it's JP Morgan that owns the money. They're simply arranging the transaction. But this anonymity is helpful for JP Morgan because they're less likely to move markets. Last but not least, we have a participant known as central banks or Treasury. And this is like the elephant in the room, or at least the horribly deformed elephant. And central banks are very different in their motives from all of these other entities that are trading in the foreign exchange market. It's because they don't actually care about profit, unlike all of these other entities. Banks, the dealers, the brokers, a little bit like firms, actually. But what a central bank does care about is the value of its currency. And so this is not so much, central banks are not going to be big participants for countries that have a complete free float of their currency. For countries that don't really try to manage their exchange rate, like the United States or the Eurozone. But it's a big deal for countries that try to manage the value of their exchange rate. And they may do that for volatility, that is to reduce the uncertainty about what the price of their currency is going to be in the short term for various corporations and other entities that need to trade. And they may influence the value of their currency to facilitate imports or exports, to influence trade, as we just talked about. So their intent when they interact in these markets is not to make profit trading, but is to simply influence the direction of the currency to push it in one way or the other. So if the Chinese yuan, for example, is 7 to the US dollar, and the Chinese government feels that a yuan below, say, 5 yuan per dollar right now is much too strong. That is, the yuan is too overvalued against the dollar. And you can see that again because in this case $1 buys fewer RMB. So the dollar has become weaker, conversely the yuan has become stronger. Then if the exchange rate moves through time and perhaps the government tolerates this degree of uncertainty, but if it does move beyond this band, below this floor, so that the yuan is too strong, then the central bank will actually sell RMB out in the open market, out in the foreign exchange market. They'll sell a ton of RMB. They'll buy other currencies, probably they'll buy dollars as well as other currencies. And what that will do is weaken the value of the RMB, and perhaps at this point they'll stop and let it drift during its normal range. So you can see central banks don't trade in the foreign exchange market for the purpose of making money. In fact, they may have actually lost money by doing this trade. But they do it because they desire a certain value for the currency. And we'll spend a lot of time during this course discussing why a government would want a certain exchange rate.